Now let's take a look at the bigger picture. Ira Rothberg's with us, portfolio manager of the Hennessy Focus Fund. Thanks for being here. So it looks like we're about to snap the recent record streak. But are you feeling still positive or not so much?
I'm feeling very positive. It looks like Chairman Powell and the Federal Reserve are going to be able to stick the soft landing. But we really build our portfolio in the Hennessy Focus Fund from the bottom up. And I'm excited about our individual positions. It is also supportive of the market that we have seen inflation really start to ease, shelter, rent really start to ease, and the job market start to soften a little bit, allowing the Federal Reserve to ease, later this year.
Right. Are you in the camp that we're getting at least one cut, maybe two? I don't know. You tell me. And what timeline do you see for those?
Based on Chairman Powell's testimony in front of Congress, it sounds like the Federal Reserve, the FOMC, is getting much closer to easing, and it may in fact happen before the election. I think there are a number of consumer discretionary names, big ticket consumer discretionary names that have lagged, and many of the products that they sell are financed, and so I would expect a recovery or reversion to the mean in many of those names.
Right, understood. So how's the Hennessy Focus Fund doing? HFCSX. How would you describe, running this kind of fund over the last few months, and what's your outlook?
Sure. So we run a very concentrated fund with generally between 60 and 80% of our assets in the top 10 positions. And we're a very low turnover fund with about 10% annual turnover. So we're typically adding 2 or 3 names to the portfolio on an annual basis, and we can be very selective. I'd say, if you look at the last 6 months, there's been particular underperformance in small cap equities relative to large cap. In fact, it's been the largest underperformance of small cap relative to large cap in history through the first 2 quarters. And so we see particular opportunity in a number of smaller cap businesses.
Yeah, and look at small caps today. Are you surprised to see that move? I mean, this is probably the best move of the year. It's up 3.5% for the Russell.
It's interesting. I mean, it's only a 10 basis point decline in the 10-year Treasury yield, but there's so much of the trading in the market is based on factor risk, and so much of it is algorithmic. So it's odd to see the Nasdaq down 2% when many of the higher growth tech companies in the Nasdaq, the Magnificent Seven that have been driving a lot of the performance. You run a DCF model, you lower the discount rate, it actually increases your intrinsic value calculation. So it's odd to see this big rotation, but certainly the Russell 2000 is definitely underperformed.
So I thought it was interesting how you said you have a majority of the money in the top 10 holdings, and so I also have your stock picks. I don't know if they overlap. What are some of the big holdings that have served you well in the fund?
Sure. A long-time holding in the fund is our position in Ashtead Group. They own Sunbelt Rentals, which is the second largest equipment rental company in the United States with about 11% market share, second only to United Rentals. And what's interesting about this business is they operate in a highly fragmented industry where mom and pops control the majority of the business in equipment rental. And the company is really benefiting from government largesse, things like the Inflation Reduction Act, the CHIPS Act, the Infrastructure Act, and some of these very large mega projects, call them $450+ million. Only a couple companies, only Sunbelt and United Rentals, can really serve those big projects. And the big companies are advantaged because they have a better equipment availability, better service levels. They're able to buy equipment at a bigger discount from the equipment manufacturers. And the industry is transitioning from equipment ownership to rental, which is a long-term growth driver for Sunbelt. This is a company that we think can go from about 11% market share to about 20% market share over the next decade. And in the process, we think they'll be able to compound their earnings per share at least a 15% clip. And the business is available at a compelling valuation of about 15 times our estimate of next 12-month earnings.
Wow, that's some big projection to double market share. That would be wonderful for this company. I don't know if you get to speak with the CEO. I mean, sometimes the smaller companies are a little more accessible, but certainly an exciting prospect for growth there. How about AST SpaceMobile?
Sure, a slightly smaller cap company, an earlier stage company. Just a little background: we've been shareholders of American Tower, the country's largest cell phone tower owner and operator, for more than 2 decades. And our investment in AST SpaceMobile is really an outgrowth of our knowledge of the tower industry. The terrestrial network can't really serve all geographies across the continental United States. There are holes. I mean, my phone calls drop from time to time. They're dead spots. And AST SpaceMobile is partnering with mobile network operators like Verizon and AT&T to fill in those dead spots. So if you're in a national park or you're driving from New York City to the Hamptons, your phone call won't cut out. And they are building a constellation of low Earth orbit satellites that will deliver that service to you. And it's a business that should have very high margins. And the opportunity is not just a domestic opportunity. They have relationships with over 45 MNOs across the globe, representing more than 2.8 billion subscribers. If you run the math on very modest assumptions about their average revenue per user and their penetration rates, the revenue numbers could be enormous. This could be a company with more than $10 billion of unlevered free cash flow, with a market cap today of just over $3 billion. And I should mention that John Stankey, the CEO of AT&T, has commented that he thinks 30 to 40% of his customers will take this type of supplemental service from a provider like AST SpaceMobile. So a very exciting opportunity in our portfolio.
Yeah, I mean, these are sort of in the weeds, but not, because they have a footprint that can certainly grow and have the backing, or at least some positive comments from the likes of AT&T. I know you have CCOI on here as well in the world of also in the world of communications, internet communications. But what's interesting is the theme about how you're going about picking these stocks. You're not looking for high flyers or crazy growth stocks or Mag 7. You think that these have these sort of wide moats, I guess, or value that seems more attractive?
Yes, we're trying to buy businesses that have a wide economic moat, so sustainable competitive advantages that allow them to earn an outsized return on capital for an extended period of time. And we're looking for businesses that can reinvest their profits at high rates of return. They have long growth runways. And we're looking to partner with management teams that excel at operating the business and at allocating capital. Because if you're going to own a business for 10 plus years, a lot of capital is going to get allocated over your holding period. And we've been able to find businesses trading around a market multiple on average that generate about twice the level of earnings growth as the market. And so we'd like to own these growth businesses at discount valuations when they're misunderstood or out of favor.
All right. Good to see you. Ira Rothberg, Hennessy Focus Fund. Thank you for the conversation today. Appreciate it.